Have you ever looked at the stock market and thought, there's absolutely no way I could understand this? Maybe you've seen those numbers flashing on a screen. Red, green, arrows going up and down, and it all just felt like chaos. Well, here's the truth. The stock market isn't about being the smartest or the fastest person in the room. It's about being patient. When you learn to ignore the daily noise, the market stops being a source of stress and starts becoming something else entirely. And you'll realize it's actually the most powerful tool you have to build long-term wealth. In today's video, we're going to break down the stock market step by step using a real-life example. And by the end, you won't just understand the market. You'll have the foundation to navigate it with confidence. So, what is the stock market? The stock market is simply a system that allows people to own small pieces of businesses. To see how this works in real life, let's use a simple example. Imagine a man named John. John wants to open a grocery store in his neighborhood. He's done the planning, found a good location, and knows people nearby need it. But there's just one problem, which is money. To be able to open the business, John needs $500,000, but he only has $100,000 in his savings account, which is not enough to open the store. So John makes an important decision. Instead of doing it alone, he asks for help. He goes to people he trusts, friends and family, and says, "If you help me put money into this business, I'll give you a small piece of it. If the store does well, you benefit too." One of her friend Jane, who heard about the offer, agrees and invests $100,000 into the business, meaning she gives her money in exchange for ownership with the expectation that the business will grow and her money will grow with it. Again, his brother Michael invests $50,000. Others contribute smaller amounts. Together, they raise the money John needs. Now here's the twist. John still runs the store, but he doesn't own it alone anymore. Everyone who invested in the business now owns a small part of that grocery store. This is the foundation of the stock market. John's grocery store represents a company. The small pieces of ownership given out are called stocks. When you buy a stock, you're doing the same thing, owning part of a real business. In essence, you can say that a stock is ownership. For instance, when you own a stock, you own a small piece of a business. Think again about John's grocery store. Instead of owning the whole store himself, John divides the business into many equal pieces. Each piece represents a portion of ownership. When Jane invests her money, she doesn't just hand it over and hope for the best. She receives some of those pieces. That's what makes her an owner. Now, because she owns part of the business, she shares in what happens to it. This makes her a shareholder, which simply means someone who owns shares in a company. If the store grows, her ownership becomes more valuable. For example, if the grocery store's value increases from $500,000 to $1 million, the value of her investment doubles. But if the store struggles, the value of her ownership and her investment declines. This is where many people get confused. A stock is not just a number on a screen. It's not a game. It's a real claim on a real business. And the same idea applies to public companies you already know. I know you might ask, what's the difference between a stock and a share? Here's the simplest way to think about it. A stock is the entire business. A share is one small piece of that business. Another way to remember it is this. Stock is the category, like fruit, while a share is the specific item, like an apple. In essence, you don't buy fruit, you buy apples. In the same way, you don't buy ownership all at once, you buy shares of a stock. Let's use NVIDIA as a real-world example. NVIDIA is a company. When people talk about NVIDIA stock, they're referring to ownership in the business. If you own the stock, you are one of the owners of the company. That ownership is divided into many small pieces called shares. When you buy one share of NVIDIA, you own a tiny piece of the NVIDIA company. If you buy more shares, you own a larger piece. The value of those shares goes up or down based on how NVIDIA performs as a business and how investors feel about its future. So, when John divided his grocery store into 1,000 pieces, each piece became a share. The more shares someone owns, the larger their ownership. For example, if Jane owns 250 out of the 1,000 shares, she owns 25% of the grocery store. So when someone says they own stocks in multiple companies, what they really mean is that they hold shares in each one. Now that you know what a stock and share mean, let's look at where people actually buy and sell these shares. That's where the stock exchange comes in. A stock exchange is simply a marketplace. It's a place where buyers and sellers meet to trade ownership in companies. In the United States, the two main stock exchanges are the New York Stock Exchange and NASDAQ. Now, here's the beauty of it. You don't need to visit these places in person. Today, buying and selling happen online through brokerage platforms like Robinhood, Fidelity, or Charles Schwab. But behind the scenes, the stock exchange keeps everything organized, regulated, and trustworthy. It's what turns ownership into something people can buy and sell with confidence. But you might be wondering, why would a company sell pieces of itself? Why not just borrow money from a bank? Let's go back to John's story. 2 years have passed and his grocery store is now doing well. Customers are coming in and sales are strong. With this growth, John decides to open a second store in a new location to increase profits and build his brand. But there's a problem. The money he has saved isn't enough for the type of location he wants. To move forward, John needs an additional $200,000. To raise that money, he has two choices. The first is a bank loan. But loans come with a pressure. He has to pay the money back on time, with interest, no matter how the business performs. The second option is to sell more shares. By selling ownership instead of taking on debt, John raises the money without owing anyone repayment. Investors take on the risk, and in return, they share in the rewards if the business grows. This is why companies issue shares. It's not weakness, it's strategy. Companies use share issuance to raise capital and scale globally without drowning in debt. Now, let's connect everything together by looking at how the stock market works from start to finish. The first is that when a company grows large enough and decides to offer ownership to the public, it starts with what is called an IPO, which stands for Initial Public Offering. An IPO simply means a company is opening ownership to everyday people. During the IPO, the company lists its shares on a stock exchange and sets an initial price for those shares. Once the shares are available, anyone can buy them through a brokerage platform. At that point, the company no longer controls the share price. Prices move based on supply and demand. More buyers than sellers? Price goes up. More sellers than buyers? Price goes down. That's it. No mystery, no hidden hand. Just people buying and selling ownership. This is where the chaos we talked about comes from. The price on the screen is just a reflection of how people feel about the business at that exact second. But remember, while the market controls the price, the company still controls the results through controlling its products, its sales, its profits, and its growth. And over time, the share price follows those results. So when you understand this difference, the noise loses its power and you stop reacting like a trader and start thinking like an owner. Now, why do people invest in stocks? The major reason is that leaving money idle in the bank doesn't work. Most savings accounts barely keep up with inflation, which means money sitting still in the bank slowly loses its purchasing power. The stock market, on the other hand, has historically grown much faster over long periods. That growth has allowed ordinary people, not just the wealthy, to build long-term financial security. For example, think about people who invested in Nvidia stock 5 years ago. The value of their investment has more than tripled. The same is true for early investors in companies like Tesla and Apple. That's the difference. Now that you know why people invest in stocks, the next question is simple. How do investors actually make money? There are two main ways. The first is capital appreciation. That simply means the value of your shares increases over time. The second is dividends. Dividends are payments companies make to shareholders from their profits. We have a video where we discussed capital appreciation in details, which you can check out. For example, if John's grocery store earns a profit and he decides to share part of it, investors like Jane will receive part of that profit in cash without selling their shares. That cash payment is called a dividend. You can think of it as money investors receive simply for owning shares of a company. However, only companies that choose to pay dividends offer this. This is why many investors love dividend-paying companies. And many investors reinvest those dividends to buy more shares. By doing this, they slowly increase their ownership in the company without adding new money. Over time, those extra shares can generate even more dividends, which further accelerates long-term growth. That's the power of compounding, which smart investors use to build seven-figure portfolio. But does it mean there is no risk involved in the stock market? The simple answer is no. Every investment carries its own risk. Markets go up and down. There have been crashes, from the dot-com bubble to the 2008 financial crisis to the 2020 pandemic. But historically, markets have always recovered over time. This is why patience matters. The longer you stay invested, the more powerful investing becomes. In essence, time does the heavy lifting. Now you know how the stock market works. Wealth isn't built in weeks, it's built over the years. We began with a simple story about a grocery store. Through that one story, you learned what stocks and shares are, how exchanges work, what an IPO means, how growth and dividends create returns, and why risk matters. Remember this, the stock market isn't chaos, it's ownership. And once you understand that, everything changes. The best time to start investing was years ago. The second best time is now. Remember, this video is not financial advice. It is only for educational purposes. Investing and trading are risky and can wipe out your portfolio if you don't know what you're doing. Always do your research before investing, and do not invest what you cannot afford to lose. If you found the video helpful, like, share, and subscribe. Thank you.